Good afternoon, everyone, and thank you very much for joining me today. My name is Patrick Nelson, and welcome to this session, which is on an investment which is ultimately benefits from market volatility and dispersion and flux and so forth. So probably a fairly timely topic given the last 3 days in the Aussie and worldwide markets. Before I get going, I might just quickly do a sound check. If someone can hear me, just type yes into the chat box. Thank you very much, Danny. All right, so my name's Patrick Nelson. I'm the MD of Reach Markets, and in short, Reach Markets, we're the education partner to the Australian Stock Exchange in options trading. We build technology for options traders. We spend a lot of time talking about volatility and measuring it and trading it. But we also work with wholesale and professional investors, and we offer, we have a close network of venture capital and private equity firms that we work with, and we offer a range of different investments that otherwise aren't available to the market to our investors, and work closely with our investors to help them get access to the information they need to be able to make informed and relevant decisions. So putting you in front of good opportunities and then allowing you to be able to do your due diligence to make a decision that it's appropriate for you. The investment we're looking at today is a little bit out of the norm in terms of the type of investments. This is an investment which is a structured product, which quite often our investors don't have a huge appetite for. But over the last 6 months, we've been looking at ways of being able to hedge our portfolio using volatility, dispersion and those types of things, so we can price in hedges to protect ourselves of what we think is an inevitable event, and that is that there will be a significant event which creates not a correction. At the moment, we're still not saying that this is anything other than a blow off top or a correction, but a significant jolt to our economy, geopolitical issue, and the coronavirus at the moment, which has got hopefully doesn't escalate, but if escalates into a pandemic, could have far-reaching implications for worldwide economy and markets and the like. So having ways of being able to hedge in those is really what this investment is about. So the investment is structured, and as I mentioned, we normally are not looking at the structured products, but this is one that we sought out. It was put together for hedge funds, predominantly to be able, by an investment bank, for hedge funds to be able to either take a view on market volatility increasing and dispersion increasing, or to sit there as a hedge in the event of a major crisis, right? And as such, that's why this investment has come about, and one that we are tracking, and we've had some very good success with past investments of this time in recent times. So any advice contained in this presentation today is general only, doesn't take into consideration your personal circumstances. You need to decide for yourself whether it's appropriate for you, and past returns are not an accurate indicator of future returns. We only provide general advice, so therefore, if you're seeking advice, you need to ensure that it's appropriate for you. All right, so why would you want to be long dispersion and volatility? I guess I've put up here the picture of a black swan next to coronavirus, and I'm sure many of you have referenced black swan events before, but an abridged history lesson came about, just references a rare or unpredictable occurrence, and it came about from European explorers who thought they knew everything, and they thought that swans were only white, and found that no, in fact they were black, and so it was something that came out of the blue. It was unpredictable. They weren't thinking of it, and it came about. Now, black swan events from a Wall Street perspective, or from a market's perspective, when something comes up that we're not thinking is not on our radar, but can really have a massive impact or start a trigger or a movement. And coronavirus has got the hallmarks of that. I think that at the moment the best way of handling this is if they can stem the flow of people moving about that have got it, and isolate it and get some first world medical treatments in there to actually stem this and to protect people against it. But we are very worried about the escalation, and people are talking about the chances of it going that way, the impact that it has. We were just discussing in our newsletters and the like over the previous couple of weeks or since January that, you know, businesses that we could see were being affected. You know, we stopped travelling to Asia. We're over in Hong Kong and Singapore at the time that it really hit the news. And thankfully, we're out of those regions pretty quickly before we'd seen sort of infections creeping. And you know, it's just escalated from there. And the more you read about it, the more you really worry about where this can head. But we're not saying that this is going to be the trigger. At this point in time, I believe it's too early to say that it will be the absolute trigger, but it could be, and it's something that we're all very, very worried about. Other things that will impact volatility, market corrections, and send shares in different directions will be, you know, markets, you know, the bull market finishing, and we're in the longest one we've had. But remember what volatility was doing 2007, 8, 9, 10, and compare that to what it's doing now. So we're coming off very, very low levels historically. And you know, our attitude to what's going to happen next is, and how relaxed we're about things has changed, or the market generally has changed over that period of time. Other triggers, I mean, we saw a de-escalation of this trade war. I mean, Trump's obviously going into an election, and it's been, you would say, definitely in his interest for things to be nice and stable. Xi Jinping, you know, there is was a very popular leader, but going into this, his popularity has been significantly affected. That could be used by his enemies. That also could trigger social unrest, and these sorts of things could definitely be triggers. We know what we're dealing with China to an extent. We might, you know, we might not always like it, but we kind of understand what their MO is. If new leadership was to move in, or social unrest was to creep into China, that could definitely be a trigger for other factors and problems with our economy and markets going forward, and be a trigger. And what's Trump going to do if he gets re-elected, which looks very, very likely? Last term, well, hopefully, who knows with Trump, you know, but last term is probably when you'll really see him trying to execute on his agenda, and what's he got to lose, you know? So that can also create some volatility and some unrest and potential challenges within the market. But we've been in this 11-year bull run. The last one was, what, 9, getting towards, you know, 10 years, but that was the longest in history. We're now into our 11th year. You know, will it be 11? Will it be 12? Is this what we're seeing now, the trigger? Will it be something else? You know, we're not saying we can predict it based on what's in the market at the moment, but you would have to say that, is it going to be 12 years? Is it going to be 13? Does anyone think it's going to be a 13-year bull run or a 14-year bull run? What will, you know, but at some point in time, there will be something significant that triggers things. We don't get away with these things forever. Our bull market runs have, as we've had more triggers and more levers and more planning around how we manage our economy and markets, have gone on and on. But where we sit right now, what do we do next time? We can't exactly drop interest rates, can we? How much money can you flood into the system? We're in a slightly different situation. So, well, while we might have an issue that comes up, we're very well, the stocks are very well valued. So whilst we might have you know, in the past have had a wobble, we've been able to fix that by throwing money at it, or you know, dropping interest rates and the like. That's not necessarily there for us this time around. So you know, these sorts of factors mean that we think that it's getting closer to an event where you would want to have a hedge in place, or if you already have a view, then this is a way of doing that. So the setup is giving you a hedge. It's an international hedge. It allows you, it's designed to give you significant coverage. So you're not in a position where you have to short sell. You're putting a hedge in place. The risk of your investment into the hedge is capped, but your potential upside is not capped. All right, and it's there because either you've got a view that there's going to be an event and that the market is going to pull off significantly, volatility is going to increase, dispersion is going to increase, and the like, and you want to trade that view. That's one reason why people would take this particular investment, and the other is you simply want to have a hedge. You've got a portfolio which likes the market. For a lot of our clients, they're investing in things where they're not that worried about market movements day in, day out. They've got more long-term views, or they've got more yield attached to their investments, and they're more structure and get facilities and that, and those types of investments. But definitely those types of, all investments prefer the market to be ticking along and volatility to be low. So having something that gives you that hedge against those sorts of escalations is definitely another reason why people would look at this type of investment. Just the numbers behind it and the setup is, if you wanted to get a $200,000 worth of exposure with this investment, it's a $14,800 in your outlay, gives you 2-year investment term. Your maximum risk is the $14,800, and your uncapped upside is based on $200,000, right? So it gives you that ability to get in. Now, volatility, the pricing of the investment is done off volatility over a period. So even though volatility is spiked, it still gives us the opportunity to buy volatility on an average price, which is very much on historic lows at the moment. All right, so it's designed to perform with increased market uncertainty, and we benefit from, well, what happens when there's that increased market uncertainty? So going for a short on the market is one way of doing it, but in this case we say, no, what things happen when uncertainty, and then how do we set up an investment that gives us the best way of pricing in at low levels so that when that uncertainty comes in, we can benefit from it. And the two things that we structure off this is dispersion and volatility. Now, what is dispersion? Dispersion, I guess it's the opposite of something being highly correlated versus something being dispersed, right? Now, how do we measure that? Well, we look at, in this instance, this is the red line here is the index, and the blue line is a stock, right? So the difference between the index and where a share price is moving is how dispersed it is. So if you can see, there's a fairly high correlation between the stock, and then at different points in time that widens to the point where here it is quite dispersed, right? So that's one element of it. And so if we're looking at setting up a basket of stocks which would be highly correlated, but in the event of different things occurring in the market, like inflation blowing out, currency issues, things like Brexit, a trade war, Chinese, exposure to the China market, those types of things. So, for example, Apple, right? It has been affected by its ability to manufacture in China. Significant impact on its manufacturing and also the distribution of its products, right? So that is an example of a stock that would be impacted significantly. And as an event or these different events come in and play, these stocks head off in different directions. So that's dispersion. So it's put together, this particular basket of stocks is put together by an investment bank specifically for hedge funds who are looking to trade a view that market volatility and events are going to be, negative events will occur and have a negative impact on the market. When that happens, the dispersion will significantly increase and volatility will increase. All right, and this basket was specifically put together to say, well, they're highly correlated now, but we're not expecting them to be when these events trigger. So low dispersion versus high dispersion. Dispersion is something that we talk about when we talk about investing. A lot of the time it's, where do you get alpha from? How do you add value to an investment portfolio and the like? And in a market where things are just ticking along, low volatility, market's sort of generally just bullish and ticking up, everything sort of, some things will go up higher and lower than others, but everything sort of ticks along in more of an orderly fashion. And if you're a funds manager at that point in time, it's actually quite hard to add value. Whereas if you get into a market where people are moving towards value stocks, or they're going towards, looking for, for different things. Different sectors perform well and some perform poorly and so forth. You can add a lot more value of a funds manager. But they're the difference between a low dispersion and a high dispersion market. So what we're seeing is we want a basket that looks something like this, and then when there's a major economic event, it looks more like this. All right, we're not worried about the net overall performance of the companies. We're worried about the difference in the performance of each company to each other, and that allows us to get that hedge in. The other thing we're looking for is volatility, and volatility has moved off, from, as a derivatives trader myself, volatility levels over, the last decade have really come off to very, very low levels, and even the movement in the volatility is completely different to what it was in the past. And so we're really trading in off very, very low levels, and it's an opportunity to set up an investment in a hedge that doesn't always exist, right? So looking at implied volatility, we might have a range of between 11% and say 17%. If I was going back to 2009 on implied volatility, I could be anywhere up to sort of 40%. Right, and so the opportunity to get in at really low levels and then be able to, as volatility explodes, really benefit from that, just even moving back to normal levels is a plus. But if it goes up to significantly higher levels and stays up at those levels, this is a very, very good result for this investment. So what we're seeing at the moment that makes this hedge particularly interesting is that volatility is down at these lower levels, and correlation is also down at lower levels as well. Now, in terms of the performance of the investment, what we're looking at is the dispersion hurdle, dispersion less the hurdle at maturity. So we're looking for this dispersion growth, and we've seen with the recent investment that we had put in place about 6 months ago, I think we're up at around this 13% level based on an expiry valuation in that period of time. So that it's already started to really do its job. But in the this investment is designed obviously to give you that. You've got $500,000 investment exposure, but your net outlay is significantly lower. All right. All right. In terms of the setup of the investment amount is $500,000. So effectively, what we do is it's set up as a loan. It's a very low interest rate, 2.95%, which gives us the amount plus the advisor fee, which gives us the total amount that we're setting up for. All right, so investment is $7,900. If you wanted $100,000, it's $7,900 to give you that $100,000 exposure, and you can take it up to whatever number you want. We've got capacity to go up into very, very large hedges in this position, so it's really up to the individual as to what they want. The advisor looking after this investment is David Sellers, and Blake Reed is also assisting on that. So if you've got technical questions, you can speak to them and they will go through and answer any questions you've got. All right, so again, based on a $200,000 outlay, your net exposure is $14,800. It's a 2-year investment term, so that investment is open for that period. You can close earlier. If there is a massive spike in volatility and dispersion, we don't have to wait to the end of the period to realise our gains. We can close out of it earlier. If there is only a moderate, just like it just shifts back to previous, then you'd want you just hold on to it, because the delta on the trade will improve towards the end period of the trade. So you stay in it and leave your hedge open for that 2-year period. You don't have to close out early. But if there is a massive spike, then you can definitely get out of it earlier. Right, so why would people consider this? Well, most people's portfolios is full of things which have rosy outlooks and are going in there with the hope that everything is going to happen in an orderly way. The reality is that at different points in time, that's not the case. and having a hedge in your portfolio is not a bad idea. We've been looking at this over the last 6 months, as I mentioned. We've done a lot of work around this. We had good success with these investments. It's been definitely our view that we're getting closer to a point in time where we see bear market conditions come back in. The trigger for that, we don't know. This is definitely a reminder that things happen out of the blue, and when you're in the later play of a bull run, and we've used and thrown all the methods that we would have for extending economic growth and keeping everything rosy, those levers that we've got to pull are not necessarily there anymore. So the next round of problems, we see it's getting closer to where we might see a bear market come and cause us issues. So if you believe that there is a good chance that an economic event is going to occur, then this is definitely a way of setting up a hedge. The increased volatility in the market, a correction over the next 24 months, these are all things that this investment is set up to benefit from. And it's there, regardless of whether you want it as a hedge, whether you want it because your view is that these things are actually going to happen, you can trade this either way. All right, it can sit there as in support, or it can sit there alternatively because you've got a view. All right. Despite our recent little movements in volatility, it's still got the ability to price this in because of the way they structure the investment. It isn't priced on the day of the trade, it's priced on a period of time pre. So it gives us the ability to go in and price the trade up at historically very low levels with high correlation in the market, and with the opportunity to benefit from those changes as they just even move back to historic norms, right, and then revert back to their mean. But a major event, so you can benefit from that. It can be a great trade for you from that perspective, but a major event, this is what this investment is designed to assist with. So anyway, there you go. That was an outline. I don't want to take too much of your time up today, but certainly if you've got any questions, by all means, please ask. Now, let's have a look. Jeff's asked, all right, so what are you actually investing in? So, again, this is a structured product. It's been put together by an investment bank, and it was put together specifically for hedge funds. We've got access to this particular investment, so it's a structured product. The asset managers go long volatility, which is call option, and short correlation, which is a put option, and they put it into a reference basket, right? And so the benefit of this is it's an easy way to access an international investment that gives you that, the ability to get in there and go short, and it's really cheap interest rate that helps you get set into this because it's pooled capital, right? And going in and trying to set up a put option in a similar fashion is, the interest or if you like for like interest that you would pay on that would be significantly higher. All right, any other questions? All right, so John's asked, what does the hurdle rate mean? It's the rate that the dispersion has to pass before you can get returns. So this is in place. It allows that cheap entry rate, 2.95%, but there's also, without this, the interest would be significantly higher, and which would make setting up a hedge in place something that was a lot more expensive. So it really allows us to keep the cost of it down, and to use the hedge for what it's designed to do. So it's not designed for things just slightly adjusting. It's designed so that we can benefit from moving back to historic norms, or it's there for us to be able to really benefit from a major move, and that allows us to get a significantly larger exposure as well. David's asked, where New Zealand residents can we access this investment? I might get David Sellers to just reply through the chat, the chat for me there. I believe so, but it's an Australian investment memorandum, so I believe it can. All right, g'day Noel, how you going? So Okay, so David sells in regards to New Zealand residents. David said, depends on the setup of the account. Usually on an issue, David will reach out to you. David Sells will reach out to you, David, to find out. But it should be okay based on his comments there. Noel's asking, when does the cost margin have to be paid? So basically, if you're, in the example I gave, which was a $14,800 to get $200,000 exposure, so that $14,000 is paid on setting up the investment. That's your total exposure. There is no margin calls. There's no more to be paid. You pay upfront, and that payment is made upfront, and that is it. All right. So to get your exposure, you make that payment upfront. Right. And this particular investment closes in a couple of weeks. I might get Dave just to put the exact date on there for me. And I'll read that out in a moment. But we won't be leaving this open for a long period of time for obvious reasons, but we do want enough time for everyone to be able to get organised to be able to participate. We've had a lot of people go into these investments in the past. Or when I say a lot of people, no, that's actually not true. There's been a significant amount of money invested, not a huge amount of people have participated, but a significant investment has been made in these. And the first one we went into has performed very, very well in a very short period. And even in a period where we're ignoring the recent volatility, even in a period where it's, where volatility has been flat, the dispersion of the stocks has increased, which has been where the benefit has been. Jeff, I'll get Dave to specifically answer that, and there are some charts. So Jeff's asking me about what does a payoff look like, what levels does volatility need to be at. I haven't included those pictures, but I believe there are some that we can provide you in the document. So if you would like to get the IM on this investment, just type IM into the chat box and we'll send that out to you, and there's more information such as to answer the question you've got there, but I can provide that to you as well. So yeah, just in the chat box type in IM and we'll get that to you. Yeah, sorry Jeff, I can't give you a more specific answer, and it's probably a good idea for me to add that into my slide deck next time around, because it is probably a pretty spot on question. All right. All right, so thanks, Murray. Okay, so the closing date for this investment is the 11th of March. All right, and so we'll be seeing this like 2 weeks from now is when we're closing off. All right, beautiful. All right. So look, guys, interesting market out there at the moment. For those of you that have requested an IM, we'll organise to get that sent through to you. If you haven't already, please just type in the letters I and M, and we'll get that sent to you. Other than that, if there's any final questions, please send them through. Look, the reason why we've been searching for these types of investments, I don't know, some of you will know Ivan Churilov, who works with me in our Reach trading business, and we run our implied volatility trading platform. We're investors, but we're very much traders as well, and we're right on and following these things is, look, we're well into 11 years of a bull run, right? History does repeat itself. It's just at what point, and what will be the trigger. Now, a trigger that might not matter 9 years ago, because there were plenty of things to do and plenty of upside for companies and valuations and so forth, and can send us into a bear market now. And we're not expecting that a bull market will run forever. We're not predicting that it's going to be year 11. We're not necessarily even saying it's year 12. It could be. There are reasons. You've got to have your own view, and I'm not here to say or have a view that the time has come right now, or that I'm predicting it's going to happen in the next week, month, even 12 months. But certainly we've been looking for hedges. We've been looking for things that can make us money. I personally think volatility will increase significantly, and that a structure like this can allow us to benefit. I do think correlation on the right basket can also benefit significantly without us even seeing a bear market or a big market correction or a big pullback, right? Those things can happen without that. That's one of the reasons why I like this particular hedge, right? Having said all of that, at some point in time we are going to see it, and having a hedge in play makes a lot of sense, even if you just want to have some sort of exposure but it just really is going to come down to your view. So last time around when we set this up, we saw some people taking really big positions and some people just saying, look, you know what, 7,900 gives me $100,000 worth of a hedge in place. I don't have a lot of stuff like this in there. I get what you're saying about vol and dispersion. I'm happy to take that trade, and I'm happy to have it there as some protection. If we see something big happen, I'm going to benefit from that part of my portfolio in a way that my other parts of my portfolio probably won't. So it's very interesting from that perspective. If you've got any more questions, speak to David Sellers. He knows the product very, very well. Obviously, a lot of you will know David well, and Blake Reed as well knows his product very, very well. So speak to either of those guys. They can answer any questions and send through any, and it doesn't matter what technical aspects. We know the product manufacturers. We can get any questions answered, you know. But other than that, thank you very much for joining me today. All the best. You know, we're all fingers crossed at the moment that this terrible virus is able to be contained. And that things can go back to some sort of normality over the next month or so. If that can be the case, we think that things can settle down and that growth can come back into our market. We do think that we're probably going to see some, maybe you know, some receding, sales recede for a period of time, but we're not calling a recession or anything like that at this point in time. But you know, it's all fingers crossed. Obviously, it's in everyone's best interest for that to occur. This is for the eventuation that isn't the case, or that some other thing comes for us, which will at some point in time be the case. So thank you very much, guys. All the best, and thanks for joining me today. Cheers. And the other thing is, if you're in Melbourne or Sydney, we are running tonight. We're running a meetup with Graham O'Brien from the ASX, Ivan Cherrylove from Trade Floor, myself, and also a lot of very experienced traders are going to be in that room. If you'd like to come along, type MEET, M-E-E-T, into the chat box, and I'll organise for someone to send you an invite. So that's tonight in Melbourne, and next Tuesday we'll be at the ASX on is it Bridge or Hunter in the city, but it will be at the ASX building, and you can come along and join us there. We'll have a drink, a chat about the market, and look at some of the tech that's being used out there, hear other people's ideas. So type in MEET and we'll get you invited along to that. Thanks, guys. Have a wonderful day. Cheers.